Stock of the day is in a similar sector as well. Boral making news today, warning of a hit to earnings thanks to lower sales volumes on the tails of the wild weather in New South Wales and Queensland. This as the spike in coal and diesel are expected to more than offset any product price increases, with the company saying its hedging is in place for most of its expected diesel usage in April, but none thereafter, and no hedges against the coal price, which coal, of course, is at record levels at the moment. And people may have forgotten that Boral does have an interest in the coal sector. Scott Phillips, what did you think of their update today, and also Boral at these prices?
Yeah, Koshy, pretty ugly update. Unfortunately, the news wasn't good across the board. Shares only down 3%. I first looked at that and thought, oh, well, the market's taken that pretty well. And then I remembered the shares have just about halved over the last couple of months. So maybe this was already foreshadowed. Maybe this is just the, the old buy the rumour, sell the fact. In this case, it was sell the rumour and sell the fact. Shares are down meaningfully. Yeah, I've been asked a lot over the last couple of months, what businesses do you buy in a rising interest rate environment? That's a whole conversation for another day. But my answer normally starts with, actually, let's start with the ones to avoid, not just the ones to buy. When you think about that, companies with high levels of debt are one. The other is businesses with no pricing power. Boral, unfortunately, is that sort of business. Very, very difficult to get pricing power with rising costs, as you mentioned. Very hard to justify or to get through sufficient price increases to cover the increase in costs. Add the rainfall that you had, that's a one-off, that's okay. It'll come and go. Hopefully it'll come and go. The once in 100-year storms are happening a little more than once in 100 a year these days, but hopefully they go away and we'll get a better future. I don't love the business, mate. It's a really hyper-competitive industry. They've tried their best. I am heartened that Kerry Stokes taken a decent chunk of it, and Seven will be very, very keen to make sure they are, sort of calling or reading the riot act, maybe is a better way to put it, in the Boral boardroom. But for now, I think one best left on the shelf.
Yeah. Howard, what do you think of the update? Because they did return capital, didn't they, after they sold the US business and dividends and things like that, which sort of cushions that big drop in the share price chart a little bit. Not a heap, but a little bit.
And again, if we channel Warren Buffett, Warren always says the three key things you look for when you're looking at metrics are consistently high return on equity. Well, this company's return on equity has averaged about 5% a year for 10 years. That's neither good nor excellent. I mean, it's exceptionally poor. And return on equity puts a cap on your return. If a company can only return or can earn 5% return on equity over the long term, that's all you can likely get out of that company in a combination of capital gains and dividends. Secondly, you want that to be achieved with low debt. Their debt's reasonably low, so that's fair enough. And you want their earnings per share to be growing materially faster than inflation. Now, Boral's earnings per share been growing materially slower than our minuscule inflation we've experienced up till now. So I hate to think what they're going to look like now that inflation is rising and looking like it's going to rise pretty high. So definitely not a company that would enthuse our members at Teaminvest. They're looking for 15 to 20% returns on a consistent basis, long term, more like Berkshire Hathaway. And you're not going to get that from a company that has a 5% return on equity.
Okay.